Good evening and welcome back to Stock Daily tonight. It's Tuesday, September 30th, 2025, 10 p.m. Eastern. We're coming to you on the heels of a resilient session where the market finished strong into the close. Nvidia carved out a fresh all-time high, set the tone for tech, and pulled the broader indices upward, while traders effectively looked through the noise about a potential federal government shutdown. What began as a choppy morning turned into a late-day show of strength, and by the end of September, the S&P 500 posted a monthly gain of roughly 3.53%, a performance that would have seemed ambitious a few weeks ago. The broader takeaway is that investors continue to prioritize earnings visibility, secular growth narratives, and any policy developments that reduce uncertainty, and that remains the case even against a backdrop where fiscal headlines can still whipsaw sentiment on short notice. Let's set the stage with the data you came for, and then we'll move into the deeper analysis on single names, sector dynamics, and the index level setup as we turn the calendar into October. On the labor front, the August job openings picture remains steady. The headline number was 7.227 million, edging above the prior reading of 7.208 million and ahead of expectations at 7.185 million. The quits rate slipped to 1.9% from 2%, which is a subtle but important signal about worker confidence. When quits drift down, it implies fewer people feel secure jumping ship for a better offer. That doesn't scream recession, but it does tell us the labor market's red-hot temperature of the last couple of years has moved to something closer to warm. Layoffs remain contained, which is your reminder that employers are cautious about letting people go. Companies worked hard to hire and train during the last cycle, and they're slower to cut when demand is uncertain but not collapsing. In practical terms, this mix tends to dampen wage-push inflation while preserving a floor under consumption. Lower quits and stable layoffs mean fewer bidding wars for talent, which in turn relieves margin pressure for companies that struggled with wage escalation in 2022 and 2023. Next, consumer confidence. The Conference Board's headline Consumer Confidence Index for September eased to 94.2 from 97.8 in August, marking the lowest level since April 2025. The Present Situation Index softened to 125.4, and the Expectations Index slipped to 73.7. Why does that matter? The expectations component is the one that correlates most closely with the next few quarters of spending and hiring. When expectations live persistently in the low to mid-70s, households are telling you they see headwinds, maybe at the gas pump, maybe in monthly mortgage costs, maybe in food, or simply in job prospects, so they pull forward fewer purchases and become more selective. The survey detail pointed out that 5% of respondents say business conditions are good, down from higher readings earlier in the year, while the share calling conditions bad remains elevated compared with the best levels of the last cycle. And when you look at job views within the survey, assessments of jobs being plentiful have cooled, while those saying jobs are hard to get are not improving materially. The implication is not that the consumer is tapped out, it's that they are trading down, looking for discounts, favoring essentials, and hesitating on durable goods unless promotions are compelling. Now, how did this macro stew translate into the tape? The short answer, micro-catalysts trumped macro worry. At the top of the leaderboard was the AI complex, once again carried by Nvidia's breakout and by a renewed bid for semiconductor names levered to data center memory and high-bandwidth memory in particular. The other unexpected boost came from biopharma, where the policy narrative produced something investors could actually price. A framework for drug pricing concessions in Medicaid paired with relief on tariffs and a path to onshoring commitments. For a sector that spent months in a fog of uncertainty over how pricing rules might expand and how tariffs might bite, seeing concrete terms, even if they're not trivial, can be a net positive because markets prefer known constraints over unknown threats. Let's begin in detail with Pfizer, because that's where sentiment turned most decisively. The day's news flow centered on an agreement between Pfizer and the administration to reduce prices on drugs sold through Medicaid to levels more comparable to other wealthy countries, while participating in a planned direct-to-consumer government platform for price transparency and cash purchases. In exchange, Pfizer receives a 3-year exemption from certain industry-specific tariffs that had been a persistent overhang, and the company committed to moving more production to the United States alongside additional capital and R&D spending. The statement referenced an additional investment of $700. Yes, $700, which at face value sounds symbolically small. Nevertheless, we will preserve that figure exactly as stated. The point, however, isn't the absolute number cited in that sentence. It's that the company agreed to onshoring and to more domestic capital projects in return for clarity around pricing channels and tariff relief. For markets, this narrows the cone of uncertainty in 2 critical ways. First, it localizes the price concession to Medicaid rather than attempting to force one-size-fits-all parity across all channels immediately. Second, by suspending certain tariffs for 3 years, it removes a cost variable that models had to inflate defensively. Why did the stock pop roughly 6.83%? Because investors had priced in a risk that policy would be both broader and harsher, potentially attacking pricing across multiple government channels simultaneously, while layering on import costs that would be hard to pass through. This outcome is not a free lunch for Pfizer or for the sector, but it is a negotiated corridor that investors can model, and that is often enough to trigger a relief rally. The secondary effect is just as important. If Pfizer's deal serves as a template, other large-cap drug makers can come to the table and hash out similar arrangements. That doesn't mean every company wins equally. Firms with a diversified portfolio, a broad U.S. manufacturing footprint, or the ability to build one quickly, and a relatively lower mix of products most exposed to Medicaid pricing might screen as beneficiaries in this kind of framework. Smaller firms or those with high import reliance may see fewer offsets. The policy channel may also evolve, and it's fair to say the government can recalibrate rhetoric quickly. But the key for investors is that today's development removes 2 of the larger unknowns that sat over the group for months. And in markets, removing a cloud can be nearly as powerful as adding a new ray of sunshine. Turning to the stock action and the levels that matter on Pfizer, the tape vaulted over near-term resistance, but stopped shy of confirming a new, sustained uptrend on the kind of weekly timeframe technicians like to see. The transcript flagged $26 as a key area that needs to be reclaimed and held to confirm a durable bottoming process, and then pointed to $27.30 as the next right-side trigger, where the character of the trend flips from oversold bounce into new campaign higher. That nuance is critical. A one-day jump can relieve oversold conditions, fill a nearby gap, or run to a 50-day moving average and stall. A genuine trend turn tends to require either a regime change in fundamentals or the collective perception that one is underway. For Pfizer, the regime change would be a policy path that stabilizes pricing without more sweeping future concessions and a pipeline cadence that offsets erosion in legacy products. If the stock can take out $27.30 on volume, your probability of a sustained trend materially improves. Upside markers beyond that include the low to upper $29 area, where prior supply sits and where earnings bulls will want to see the stock absorb sellers before continuing. Let's shift to Nike and walk through both the numbers and the narrative. The company reported fiscal first quarter results, and the headline figures presented a mixed picture that was nonetheless better than some feared. Earnings per share came in at 49, handily clearing the consensus bar. Revenue reached $11.7 billion, up about 1% year over year. The mix, however, remains a story in transition. Wholesale grew sharply. Your transcript notes a rise of 70 cents, while direct-to-consumer declined by 5%. The company's gross margin declined by 3.2 percentage points to 42.2%, reflecting sales promotions intended to work down inventory, as well as higher tariffs in North America. Net income beat expectations, but still fell 31% from the same quarter a year ago. Greater China revenue declined 9%, a tougher patch that is meaningful for a brand so tightly linked to global discretionary spend. The forward commentary is where the stock's tug-of-war becomes clearer. Management signaled that second quarter revenue will decline by a low single-digit rate, and that, for fiscal 2026, the company's Greater China business will face revenue and gross margin headwinds. They also said direct-to-consumer is not expected to return to growth in fiscal 2026, and the full-year tariff impact is estimated at $1.5 billion, higher than a prior projection of $1.1 billion. Those are weighty headwinds. They are not insurmountable, but they demand execution and, ideally, a policy tailwind on trade. So how should investors interpret the chart against that backdrop? The transcript delineates nearby resistance bands, and they're sensible markers of behavior. The first layer sits roughly at $73 to $74, which corresponds to a congestion zone where rallies have been sold before. The second layer sits about $75.40 to $78.30. Pushing through that zone would mark a break from a pattern of lower highs and could invite trend followers back into the name. Bulls can point to cleaned-up inventory, stabilizing wholesale demand, and the possibility that promotional intensity has already peaked in key markets. Bears can point to management's own admission that DTC isn't set to re-accelerate this fiscal year, and that China remains a drag. The swing factor that could scramble this equation would be any material reduction in bilateral tariffs with China that would flow through directly to cost of goods sold. If you suddenly lowered that $1.5 billion expected tariff burden meaningfully, you'd change the freight on margins quickly. Short of that, though, the burden of proof is on the company to show that DTC turns from down 5% to something closer to flat, that China bottoms and sequentially improves, and that gross margin pressure abates as promotions normalize. For now, that implies a show-me phase where breakouts need confirmation and rallies will be tested. Now to Micron, which has become one of the cleaner expressions of the AI infrastructure cycle outside of the obvious accelerator names. The transcript's forward valuation bands are telling in how wide they are. There's a band for the new fiscal year of 101 to 238, with a midpoint of 169, and for fiscal 2027, a band of 113 to 26, with a midpoint of 190. We will preserve those bands as written, acknowledging that the second line appears truncated. The bigger idea is that this is a classic cycle stock nested within a secular growth impulse. The cycle refers to memory pricing and supply discipline, which absolutely still matter. The secular impulse refers to AI workloads that demand high bandwidth memory and dense, power-efficient DRAM for training and inference clusters at hyperscalers, as well as expanding into enterprise AI and edge use cases. When those two forces align, tight supply plus secular demand, you get an earnings power curve that can move sharply upward year over year. The transcript calls out a near-term technical threshold in the $165 to $167 area, a minor resistance zone with more meaningful support down in the 150s. If the stock fails the $150 shelf decisively, you invite a broader cooling-off period where longs will want to see fundamentals, orders, pricing, mix, reaffirm that the cycle hasn't run too hot. If instead, pullbacks hold above that zone and buyers show up on routine retracements, then new highs remain in play as investors keep extrapolating robust HBM demand into 2026. Let's talk Nvidia, the market's emotional center, and, depending on your time horizon, either a benchmark of exuberance or a rational reflection of a sustained capital expenditure wave. The stock printed a new all-time high today around 186 and briefly tagged an all-time market cap near $4.5 trillion. Traders will be watching the $185 zone into Friday's options expirations. Split-adjusted round numbers are magnets on weeks like this because they interact with dealer hedging flows. If too many calls are clustered on a strike, the underlying can pin into the close as dealers manage gamma risk. But while those flows matter tactically, the strategic picture comes back to two simple questions. Do hyperscalers keep growing the AI CapEx pie into 2026? And does Nvidia's competitive moat in accelerators, networking, software, and systems remain wide? The transcript offers a practical view. So long as $185 holds into the end of the week, the tape reads as exceptionally strong and suggests higher levels are in reach as we enter Q4. If it can't hold, you can still be bullish on the story, but you accept a messier near-term path where the stock needs to reset and rebuild energy. Now, I want to zoom out to the monthly view that the transcript referenced because it's crucial for expectations management. The S&P 500 is extended on monthly momentum gauges. Overbought is the simplest word for it. That doesn't mean a top. In 2021, certain oscillators sat in overbought territory for several months while the index continued to grind higher, and the eventual pullback happened because catalysts turned, not because an oscillator flashed. The practical way to respect that lesson is to let the trend be your guide, but keep your risk controls honest. That means recognizing that extended markets can stay extended longer than you think, and trying to top-tick them on indicators alone is often a losing game. When you do see a top, it tends to come with a break in leadership, a deterioration in breadth that doesn't bounce on rebounds, or an exogenous shock from policy or inflation data. The transcript draws a helpful parallel to 2021 by noting that after a 4-month stretch of extended readings, the S&P finally corrected by about 10.476% in a single month, and then after a few months of rebuilding, the index ultimately rolled into a larger top. Whether that historical rhyme repeats is unknown, but the path dependence is consistent. Extended can become more extended, but when it turns, it often turns quickly. Let's talk seasonality and volatility, because the calendar flips to October tomorrow. October carries the largest intramonth ranges of any month historically. That reputation comes from some famous bottoms and some sharp air pockets. But volatility is not the same thing as direction. In tapes where leadership is clear, today that means AI adjacency on one side and policy-relieved pharma on the other, October often becomes a month of opportunity. Pullbacks within a strong secular uptrend, especially when accompanied by macro data that is cooling but not collapsing, can be bought with a plan. Now, because we are honest about both sides, we have to recognize the risks that could change that benign path. A messy government funding lapse that drags on and disrupts data collection or delays checks is one. A labor market print that surprises on the wrong side, either too strong on wages that rekindle inflation fears, or too weak on jobs that raise unemployment meaningfully, is another. And any sudden shift in the policy trajectory, whether in drug pricing, tariffs, or anything that affects corporate planning, can add risk premia back into multiples that have expanded on the promise of stability. With the macro and the calendar framed, let's deepen the company-by-company narrative, because this is where investors can translate a 30,000-foot view into portfolio decisions. Start again with Pfizer and the broader big-cap pharma cohort. The heart of the day's development is not that policy pressure goes away, it's that the shape of that pressure is more defined. You now have a template that says, in Medicaid, pricing aligns with peer nations. In return, there is a definable runway on tariffs and a path to onshoring support. That sounds basic, but it does two things for valuation. First, it allows investors to model gross to net more tightly because they can assume a constrained price corridor for a large government program. Second, it reduces the volatility of cost inputs from tariffs for a finite window of time. Once you can model those, you're left to do the job analysts prefer. Evaluate the pipeline, assess launch cadence, consider patent cliffs, and forecast how new products offset older erosion. If you then add the possibility that other companies adopt similar agreements, you have the beginnings of sector multiple repair, less of a policy lottery, more of a fundamentals contest. In that mode, the winners are the names that demonstrate steady top-line growth from new therapies, resilience in margins despite price pressure in Medicaid, and efficient capital allocation that prioritizes high-return R&D over low ROI buybacks. That is the kind of turn that can take a sector from an underweight to at least a neutral or selective overweight in diversified portfolios. As for the mechanics on the chart, the $26 and $27.30 marks from the transcript remain your Q levels. If the stock consolidates above $26 for a couple of weeks and then takes $27.30 with conviction, you begin to unlock a path toward the high $28 and low $29 where prior supply likely sits. Above that, there is room to argue for a return to a more normalized valuation range if pipeline updates cooperate. On the flip side, if the policy follow-through falters or other agreements are constructed with harsher terms, say faster timelines, less tariff relief, or spillovers into other channels, then today reads as a one-day wonder into the teeth of policy risk, and those levels become rejection zones rather than springboards. That's why the next couple of weeks matter. They will tell you whether this was a unique event or the start of an orderly framework for the whole group. Switch back to Nike, because consumer discretionary is where macro and micro intersect the fastest. The three biggest questions for the stock into the holidays are straightforward. First, does direct-to-consumer stabilize faster than management expects? If the answer is yes, you change the whole math of gross margins next year because DTC is higher margin when promotions aren't rampant and logistics are under control. Second, does Greater China bottom in the next 2 quarters? A sequential improvement off a 9% decline would give bulls permission to look across the valley. Third, does any policy action move the tariff needle? If that $1.5 billion estimate has to be walked back lower because tariffs change, suddenly the gross margin headwind looks far less formidable. The problem, of course, is that you can't bank on policy. You can only react to it. So absent a tariff break, the burden is on Nike to accelerate new product cycles, lean on franchises that carry pricing power even in a promotional environment, and push inventory down without eroding brand equity. The stock will try to anticipate that turn. If it reclaims the $73 to $74 band, and more importantly, powers through $75.40 to $78.30, and holds that area on the first retest, you start talking about trend change rather than counter-trend rallies. Micron deserves another pass because it exemplifies how a cycle stock behaves when its cycle is tied to a secular story. The forward banding in the transcript, 101 to 238 with midpoint 169, communicates uncertainty, not weakness. The range is wide because the earnings power is leveraged to external demand that can be lumpy quarter to quarter, but still trend materially higher year to year. In concrete terms, the bull case rests on 3 pillars. 1. HBM supply remains tight relative to demand, supporting pricing and product mix. 2. Hyperscalers keep plowing money into training clusters and increasingly into inference at scale, which turns the data center into an annuity-like customer with high-value billings for longer than prior cycles. 3. Enterprise AI migrates from pilot to production, expanding the addressable market outside the handful of megacap buyers. The bear case also has 3 familiar pillars. 1. Digestion in AI server spending arrives earlier than expected, softening orders just as new capacity comes online. 2. A supply response in HBM overcorrects and flattens the pricing curve. 3. A macro shock slows enterprise deployments at the wrong time. The way investors manage that push and pull on the chart is simple. Respect the 150-ish shelf as your line in the sand for trend health. Treat moves into the high 160s as routine consolidation zones unless accompanied by a negative fundamental surprise. And assume that, absent a negative shock, new highs are possible whenever the market's AI narrative finds fresh confirmation. For Nvidia, a final note on the psychology of new highs is appropriate. When a stock with that much index weight makes new highs into quarter end, it doesn't just drag passive flows, it resets the risk appetite thermostat. Participants who trimmed exposure into the prior consolidation find themselves underallocated just as performance pressures intensify. That is how leaders can enter feedback loops where strength begets strength. And yet, leaders also set the tone for corrections. If Nvidia were to fail the $185 zone into Friday, traders would quickly look for the next footing, and that stumble could shave momentum off peers. That's why so many managers use a two-handed approach here. Honor the leadership and stay allocated, but manage position size and stop so that a routine options-driven shakeout doesn't become a portfolio-level problem. The big picture remains the same. The secular runway looks intact as long as capital expenditures at the hyperscalers, and then in enterprise, remain committed to AI infrastructure. With the stock-specific stories framed, let's pull back to the index. The transcript's point about a likely monthly scale correction at some point is not a call to sell everything, it's a reminder to be ready. Overbought on monthly measures means you should expect, at some point, a decline measured in weeks, not days. That decline could be 5% in a polite tape, or it could be closer to 10% if catalysts line up. But if the underlying leadership doesn't break, the first sizable pullback is typically bought by those who missed the prior leg. The ingredients that would push us beyond routine correction territory are clear enough. A policy shock that reprices risk premia across sectors, an inflation surprise that forces the Fed to reroute its easing path, or a labor shock large enough to shift earnings expectations sharply down. In the absence of those, the more common outcome is that October's big ranges shake out weak hands and then reestablish the prevailing trend into the heart of earnings season. So what should investors actually watch in the coming days to keep their compass aligned? First, the labor prints. The combination of 7.227 million job openings and a quits rate moving to 1.9% is consistent with a cooling, not collapsing labor market. If the next round of employment data echoes that, moderate job growth, contained wages, stable unemployment, then the Goldilocks narrative survives a little longer. Second, consumer sentiment and retail signals. We already know headline confidence slipped to 94.2 with expectations at 73.7. If we see October anecdotes that suggest holiday spending intentions are cautious but not catastrophic, promotional intensity might remain high but manageable. Third, corporate guidance. Nike's tone was frank about the headwinds. Now the question is whether other consumer brands corroborate that picture or surprise to the upside on margins and inventory. Fourth, policy follow-through. If additional pharma deals echo the contours of Pfizer's arrangement, the sector can keep repairing multiples. If instead the next wave is harsher, today reads as a one-off relief pop. Let's close the fundamentals to technicals loop with a practical mindset. If you're a long-only investor who benefits most from capturing the big runs in secular winners and avoiding the deep drawdowns, your playbook in a tape like this is straightforward. Stay with leadership, AI infrastructure, and the highest quality compounds in secular growth, while using pullbacks to add rather than trying to time tops based on overbought signals alone. In sectors coming off policy fog like big-cap pharma, use the next couple of weeks to determine whether a durable framework is truly in place. If it is, selective re-ratings can be owned, but they still require discipline because policy can change. In consumer discretionary, let the numbers force your hand. If we see a sequential improvement in China and a reduction in promotions that lifts gross margins, the charts will reflect it quickly. If not, rallies into known resistance should be respected as potential distribution until proven otherwise. Because you also asked for a more global frame to enrich the narrative, let's place the U.S. setup into a wider market context without drowning in data. Europe is navigating its own growth-inflation balance with a central bank that, like the Fed, wants to support without rekindling inflation. That means European equities are watching the same global AI capex cycle because those supply chains crisscross continents. Japan remains a story about corporate governance reform and the durability of a weak currency tailwind. It affects global portfolios because Japan-listed suppliers to the AI stack matter for orders. China's growth cadence and policy stance continue to ripple through global discretionary demand, as Nike's numbers remind us. Commodities are quietly telling a story of supply discipline in certain industrials, while energy remains sensitive to geopolitics, all of which feed back into inflation expectations. None of these are new to veteran investors, but in a market where the U.S. megacap cohort sets the global tone, the health of these peripheral currents can either reinforce or undermine the main narrative. Before I wrap, I want to stitch together the spirit of your transcript, the sequencing of data, the pivot to stock specifics, and the through line to the indices, into a clean, story-driven conclusion that you can deliver to your audience in one take. We started with the labor market. Job openings at 7.227 million and a quits rate of 1.9% illustrate a cooling job market that supports disinflation without implying a crash. We moved to the consumer where headline confidence at 94.2, a present situation reading at 125.4, and expectations at 73.7 say households are more watchful and more value conscious. We then took the macro canvas and laid the day's stock stories on top. Pfizer rallied as a defined policy template replaced the fog of uncertainty, anchored by Medicaid pricing alignment and a 3-year tariff exemption, with an additional $700 referenced for capital and R&D. Nike's quarter was a study in a transition year, EPS at 49 and revenue at 11.7 billion. Wholesale up strongly, DTC down 5%, gross margin down 3.2 points to 42.2%, China off 9%, guidance cautious, and tariffs now expected to cost $1.5 billion against a prior $1.1 billion view. Micron's forward bands, 101 to 238 with a midpoint of 169 this fiscal year, portray a cycle stock with secular wind at its back, and the chart's 150's support matters because it's where conviction will be tested if the tape wobbles. Nvidia made a new high near 186's with market cap brushing $4.5 trillion, and the $185 area into Friday is a tactical focal point for options-driven flows. Strategically, leadership is intact as long as AI capex remains robust. At the index level, the S&P 500's monthly extension reminds us that a correction of weeks, not days, will appear at some point, but overbought is a condition, not a catalyst. October's reputation for big ranges is in front of us, but ranges cut both ways. They can break leaders or hand buyers opportunity. As you carry this into your own portfolio or your own risk management framework, the governing principle is as old as the market itself. Respect the trend, define your risk, and let the leaders lead until they don't. For the next several sessions, that means staying tuned to labor and confidence updates for the macro, watching policy follow-through in pharma for the sector read-through, scrutinizing consumer guidance for signs of an inventory-to-margin turn, and keeping your eyes on the handful of megacaps whose capex plans and product pipelines continue to propel this cycle forward. As always, I'll leave you with the levels and markers your audience can remember. For Pfizer, a stabilizing hold above 26 that graduates into a strong break above $27.30 would confirm that today's relief move has legs. The $29 zone would then become the next decision area. For Nike, watch $73 to $74 first, and then the $75, $40 to $78.30 band. The latter is the line between a counter-trend pop and a true trend change. For Micron, respect support in the 150s and let the $165 to $167 zone be your temperature check on whether the next push higher is ready. For Nvidia, it comes down to $185 into weekend mechanics. Above it, the path of least resistance remains higher as Q4 seasonals kick in. For the indices, accept that volatility in October is a feature, not a bug, and that in the absence of a shock, pullbacks inside a secular trend tend to reset risk and extend, not end, the move. That's the program for tonight. If you found value in this deep dive, balancing the raw data with sector-by-sector nuance and a clear technical roadmap, be sure to join me again tomorrow evening. We'll update the scoreboard, refine the narratives, and keep you focused on the signals that matter while ignoring the noise that doesn't. Until then, stay disciplined, stay informed, and keep your compass set on earnings power, policy clarity, and the price action that turns good stories into good trades.